success so high. I will achieve, I will fly high. In SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Last week, Uber announced that it would stop taking payments from American Express and Diners Club cards in India. The decision comes a fortnight after RBI allowed MasterCard to restart its new business operations in the country. The central bank had banned the three services from issuing new cards because they failed to comply with RBI norms for storing data in local servers. As credit card spending is zooming, the restrictions will hurt American Express and Diners Club more. Good morning, my name is Ishan Gera and I welcome you to the Business Standard Banking Show. In this week's episode, we'll discuss the important developments in the banking and insurance sectors. We have an interview lined up with Rishi Gupta, MD and CEO of Fino Payments Bank. In our Banking for You section, our experts explain the RBI decision not to permit prepaid payment instruments to draw from credit lines and its impact on the buy now, pay later industry. Our banking expert, Tamal explains the changes in the rules of bank loan ratings and the ensuing confusion. But first, here's a look at the significant developments of the week. The RBI's decision to hike rates impacts borrowers and brings gains for savers. While banks were quick to raise lending rates, over the last week, several banks including Icici, HDFC, IndusInd and Canara Bank have also announced an increase in rates for fixed deposits to woo more customers. ICICI Bank has increased its deposit rates twice since RBI announcement, and FD rates range between 2.75 and 5.75% across tenures for deposits below 2 crore rupees. HDFC is offering similar rates across categories. The experimentation is not just limited to rates. RBI and Indian banks shall pilot a blockchain project on trade financing. HDFC Bank, ICICI and SBI are banks participating in this proof of concept study that will make the trade financing process secure and fast. Moreover, it shall also rid the system of the line of credit frauds. A couple of years ago, RBI's research arm proposed using distributed ledger technology or blockchain for trade financing. Another recommendation was DigiRupee, which the RBI will also try its hands on. As banks are experimenting with new technologies, StanChart is making yet another attempt at clearing its books. As per reports, the bank is looking to sell its distressed loan portfolio, mainly rupee-denominated loans. It is seeking all-cash offers from asset reconstruction companies and hopes to close the deal by the second quarter of this financial year. The bank had reported a 53% jump in profits from India operations as per filings. To make the insurance sector more competitive, the Insurance Regulatory and Development Authority of India is looking to make sweeping changes. Yet another development that has emerged is that IRDAI may allow life insurance companies to sell health insurance. Not only will this reduce premiums, but it shall also extend the scope of insurance in the country. At present, only 1% of the population in the country is covered with non-life insurance, as against 4.1% global average. IRDAI has some tough decisions ahead of itself to transform the insurance sector in India. There's another entity which is veering towards a transformation. 5 years since its commenced operation, Fino Payments Bank, granted a payments bank license, is one of the few remaining in the field. Our banking editor Manojit Saha had a conversation with Fino Payments Bank MD and CEO Rishi Gupta on its new phase of growth and development.
Welcome to the Business Standard Banking Show. Fino Payment Bank is one of the 6 payments banks in the country and the only listed payments bank. Fino is completing 5 years of journey this month and has chalked out a plan to embark the second phase of its journey. To talk more about that, we have Rishi Gupta, MD and CEO, Fino Payments Bank. Mr. Gupta, welcome to the show.
Thank you, Manojit, and thank you, Business Standard, for this opportunity. Thank you very much.
Sir, Fino is embarking on its 2.0 version from this financial year. So what is the plan and what do you aim to achieve there, sir?
So in our first 5 years of journey, our focus has been to establish ourselves on the ground physically. And the customer segment which we are focusing on are people who are in the middle to lower middle pyramid of the country. So they need physical access and physical reach through which they can do transactions and do banking, basic banking services. So in the first phase, we have covered more than 90% of the districts. We have nearly 1 million merchants on which the transactions can be done. So after completing the first phase, and that phase will continue as such, as you would recall, Fino is always talking about the phygital model, where physical and digital can seamlessly meet. We believe our customer segments require assisted digital before they move to a completely digital model. That is why for us to set up the physical infrastructure was very, very important. And we have done quite well in that, and we'll talk about it as we progress in the interview. Uh, but the digital journey is something where our merchants are actually assisting the customers to download the Fino app, and then through that, the customers are now experiencing a digital experience or digital footprint of Fino, which the customers are experiencing. So just to give you some data, our UPI transactions are now nearly 10% of the overall value of transactions for us, which was a few percentage of maybe about a year or so back. So from a physical to assisted digital to digital, that is the phase for Fino. And Fino 2.0 talks about how we can convert our customers or help them become digitally more savvy, and so give them an option from being a physical as well as being on digital. So that is the Fino 2.0 journey.
Sir, coming to the Q4 numbers of the bank, Q4 of the last financial year was characterized by strong revenue growth.
Yeah.
What was the key drivers?
So the revenue growth was coming from largely from three parameters. First is that Fino has been focusing on how we can build up our own customer base. So our CASA and CMS has been something which has been a flagship products. So our CASA growth was quite substantial in Q4. We opened nearly 6.7 lakh customers accounts compared to 5.1 lakh in Q3. So you can see there's a 30% plus growth in our CASA. Secondly, we had a substantial growth also in our CMS business, which is the cash management services business, which we do. There also we saw a growth of more than 30% in the Q4 numbers over Q3 numbers. So those were the two substantial growth trajectories which we saw. Over and above that, we saw that remittance business, which got affected due to COVID, has started to come back, and we could reach higher numbers on the remittance side also compared to the pre-COVID numbers or during the COVID period. So 2-3 factors which resulted in a growth in Q4 substantially. If I give you some perspective, our CASA actually grew by more than 80% in FY22 over FY21. In FY22, we opened nearly to 20 lakh accounts compared to 11 lakhs in FY21. Our CMS business, which I just spoke about, have now 131 partners, and it grew by 102% in FY22 from 11,800 crores to 24,000 crores.
So last year the revenue was about 1,000 crore. What is the revenue projection for this year, this financial year?
So our guidance on this is that we will look at a growth of 25% plus on a year-on-year basis. So in FY22, we grew at about 28% on our revenue side, and we crossed 1,000 crores number. We were at 1,009 crores.
So revenue was one of the key source of your remittances, were one of the key sources of your revenue. But the remittances contribution to total revenue has fallen from 51% in FY20 to 35% now. What is the reason, and do you see further decline in the share of remittances of your total revenue?
So let me put it in terms of that our overall business is growing. In that business, the growth of remittance is relatively lower compared to the growth in some of the other businesses, which you can say is CASA and CMS. CASA and CMS in FY20 was only 7%. Now it is 18%. Remittances, which was 51%, has become 35%. But on the overall level, if you still see, remittance in absolute numbers would be higher than FY22. The kitty itself has grown, and within that kitty, we have seen ownership products and CMS products growing at a faster pace compared to remittance or even for cash withdrawal businesses.
Sir, do you think increasing competition would result in higher merchant payouts, which could dent your margins?
See, there is definitely more competition which is going to come in this ecosystem. We are seeing local players also getting into some of these businesses. So merchant payout is one of the factors which can get affected, but because of our relationships which we have with the merchant for so many years, the kind of products which we are able to offer, the stickiness which is there. And Fino, while the bank is for 5 years, the Fino group has been there for 16 years. So people understand that it is better to work with a stable, growing organization. Subsequently, with the IPO listing which happened last year, the brand of Fino has become more visible, and people, more merchants want to be associated with us because of the brand which Fino now carries.
Payments banks are not allowed to lend. Do you think it's time RBI should relook the issue and allow at least to extend small loans?
I agree with you completely, Manojit. In fact, there's been multiple representations which have been made to RBI by us, by industry forums, by other payments bank, because we are only looking at one side of the bank. So let me just put this in a little broader perspective. When I look at the payments bank, we are allowed to do all kinds of payment transactions. We are also allowed to keep customer deposit up to 2 lakh of rupees in our bank, and a partner bank we can keep more than 2 lakh of rupees. So we have payments infrastructure, and then we have some part of the liabilities infrastructure which is allowed by the regulator. So whether it's a small finance bank or within payments bank also, multiple representations has been done that while all our 100% money goes into government securities and FDs, the 2 lakh limit itself should go up. So it should actually, to my mind, should not. Why should there be a limit at all? Because it's a completely secured business. There is no credit risk, or there is no other risk as such on the deposit. And secondly, the DICGC fees also is up to 5 lakh of rupees, which is the premium calculation which we have to pay. And secondly, on the lending side also, because our customers are there in the rural geographies, they come to us and open an account and expect that at some point we will be able to lend to them. So from a complete customer offering, if the regulator can relook, now it's more than 7 years of the regulation, if the regulator can review the regulation and open up liabilities as well as micro credit for payments bank, I think the regulation or the guidelines for the banks will become far better.
That, what will be your roadmap for the next 5 years? Do you see yourself as a payment bank at the end of the 5 years? Because you have completed 5 years and you are now eligible to apply for a small finance bank. Is that something you are actively looking? Your board is looking?
So on our first 5 year journey, it has been quite rewarding. Let me put it that way, because if you, Manojit, you remember, you must have also asked me the same question: what is the payments bank model and how will it really work as such? But in the last 5 years, we actually proven that in spite of the headwinds and the payment ecosystem, which started to open up so dramatically in the last 4-5 years. Fino has crossed more than 1,000 crores of revenue, was probably one of the first banks to become profitable in the payment space, was one of the first scheduled private sector bank, and also the first listed bank as such. So in FY22, our PAT grew to 42.7 crores, which is 109% growth over FY21. So the first 5 years of journey has been quite rewarding, better than, to some extent, I would say even better than what we had envisaged. We expect that FY23 onwards will continue to maintain our revenue growth of 25% plus. There is a lot of headroom which is available in the payments bank space, in the payment space itself. We are just touching only the payments as well as the liability portion of the bank. There is still credit and investments which we can offer through partnerships to our ecosystem. So there is a lot of growth which is available in the ecosystem as we look at. Our offers to honest journey of converting customers who come for cash withdrawals as well as remittance and convert them into CASA has been quite well and well accepted, with more than 2 lakh plus accounts being opened on a monthly basis. So looking at the fact that there is still a lot of headroom which is available, we are only, while we are covering a lot of geographies, but from a customer point of view, we are only covering maybe 5% to maybe 10% of the customer ecosystem. So there is no real hurry for us to look at lending or getting into SFB from the point of view of from a business model point of view. What is interesting is the fact that we get Payments Bank plus benefit. One plus is for the liability side, which I just explained to you, that there are a lot of restrictions on the balance, which can be more than 2 lakh of rupees. And for us to become a complete bank, we would look at an unrestricted kind of a liability amount as such. So SFBs offers us that unrestricted liability benefit, as well as it offers us a lending platform. Having said that, we see a lot of play in the current model itself. So right now there is no discussion at the board level on conversion or applying for a small finance bank. But this is a piece which we'll keep on evaluating on a regular basis, and then whenever we feel there is an opportune time, at that point of time, probably we will relook at it more seriously. As you are right, the guidelines currently allows us to convert into an SFB post 5 years of completion of the Payments Bank, which we'll be completing by end of this month.
Mr. Gupta, thank you so much for speaking to Business Standard.
Thank you, Manojji, and have a nice day, and all the best to you and to your readers. Thank you.
Thank you, sir.
Gupta says the bank is paving the way from phygital to a digital model where merchants are assisting the customers to go digital. Meanwhile, RBI has another decision to make regarding how much leeway it can allow fintech players in the name of innovation. Last week, the central bank announced that it would not permit prepaid payment instruments to draw from credit lines. But what are these credit lines and how will they impact the burgeoning buy now, pay later industry? Let's find out.
RBI's decision to not permit the loading of prepaid payment instruments from credit lines has sent shockwaves down the fintech and buy now pay later industries. Fintechs are confused about the ramifications of the contents of the letter that the central bank addressed to non-bank PPI issuers last week. Industry players are reaching out to RBI to clarify the implications of this letter so that they can adjust their business model accordingly and fall in line with the norms. They are also seeking a few other dispensations from the regulator to help them transition to this new regulatory order. In the meantime, they also plan to write to the PMO, Finance Ministry, and the RBI Governor seeking redressal of their concerns. Industry experts say this move by the central bank may impact the 8 to 10 million customers in the BNPL universe. They contend it also poses a systemic risk from the lending standpoint, since many borrowers may not pay off their liabilities if some offerings are stopped because of this diktat. While there is widespread speculation on what could have triggered this move by RBI, industry insiders suggest that the central bank may not have been very comfortable with the idea of disbursing credit through PPIs, which a lot of the card-based fintechs were doing. In the last 18 months, many card-based fintech players have leveraged PPI partnerships to facilitate credit to the customers through cards. And this business model has seen a lot of traction, with these new age players adding about 200 to 300,000 customers every month, according to industry estimates. Considering RBI's diktat, many players have stopped their offerings or are in the process of doing so until the central bank clears the air on some contentious issues.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
After RBI's diktat, many players in the PPI space have stopped their offerings until the central bank clears the air. Another area where this is required is the new bank loan rating rules. Caught between two regulators, rating agencies have a challenging task in navigating the space. Our banking expert Tamal explains the bank loan rating system, the new rules, and the ensuing confusion. Hi, Tamal. Thanks for coming on the show again.
Thank you. Thank you.
This week's bankers' trust was a bit complicated. Right. So, just to simplify things and for our audience, just to explain to them, why are bank loans rated and why do bank loans need rating? I thought they do their own credit risk assessment and all. But what is this rating that happens?
Yeah, indeed, banks do assess the credit risk. They have their own risk management, credit and underwriting, so on and so forth. But that actually goes into the pricing of the loan. For the riskier the borrower, the higher the pricing. But this bank loan rating came into existence because of the Basel Committee existence. And the bank loan rating has a bearing on the capital requirement. You know, the so-called capital adequacy ratio.
Yeah.
For every 100 rupee worth of loan, a bank needs to set aside 9 rupee worth of
Yes.
capital. Now, it depends on the higher the rating, the lesser the capital requirement. Like if for a triple rated company, they don't need to set aside 9 rupees.
Mm-hmm.
Only for triple B, they need to set aside 9 rupees. And then if it's triple B minus, it becomes 150% risk weightage, meaning 13.5 rupees they need to set aside. So the lower the rating, and of course, if I am an corporate entity and I have a great bank loan rating, that also gives me a handle to bargain with banks to bring down the interest rate.
You talk about bank loan rating and bank loan rating with credit enhancement.
Yeah.
What is the difference there?
No, essentially, that CE suffix that's been used is the entities, they get comfort letter or the guarantees by their group companies or the parent. So once the parent gives you a backing, so you get that CE rating. And with CE, your rating goes up because, that you beat the Tatas and Birlas and the large corporate houses. If a group company goes and the mother company, the parent gives the credit guarantee, like in case of any default, I will step in and I'll take care of it.
Now, this is very interesting because you mentioned RBI and SEBI both in the article, right?
Yeah.
So who is the regulator there? Because that's a bit confusing there, whether it's RBI or SEBI.
No, there is no confusion actually. Globally, the raters are primarily regulated by the capital market regulator. Mm-hmm. Internationally, that's the trend. In here also, SEBI is the primary regulator. And I would say Reserve Bank of India is a secondary regulator. Reserve Bank of India comes in for the bank loan ratings. Whereas, as an entity, corporations, they also have other instruments, NCDs, bonds, etc. Yeah. Where the SEBI comes. So SEBI is the primary regulator. If you see all the master circular, all the guidance, etc., it's done by SEBI. Whereas Reserve Bank of India actually directly reaches out to the rating agencies and tells them what's to be done or what's not to be done.
You mentioned the guidelines. So what has changed in the guidelines? 1. 2, how will it impact the sector? Because you talk about capital requirements. So would banks' capital requirements change after October 21st, as you mentioned?
Yeah, this is the guideline. Actually, it's basically a very strict now. Probably Reserve Bank of India has come out instances where the comfort letter or the guarantees given by the parent, it's not enforceable. We don't know. I am not privy to any such information. So now RBI makes it watertight. It's the responsibility of the credit rating agency that you have to see every aspect that indeed this is enforceable. Mm-hmm. So that's the case. Now, if that happens, my presumption is this. All the the universal triple-rated companies, there could be instances where the raters will find out that these guarantees are not enforceable. So they need to bring them by a few notches. And if this indeed happens, so certainly the bank's capital requirement will go up. And other things can happen. Say, I am a corporate entity. I have a bank loan rating as well as I have some NCDs and other debt instruments in the bond, in the form of bond or something like that. Now, if the raters follow RBI very strictly, which is very strict, now give me one sort of rating for my bank loan, and if they are, and I may have another sort of rating another gradation of rating for my other debt instruments. So there could be confusion, but it's at the end of the day, how the raters are treating it. For all you know, if I am a rating agency, I may follow the same norm. That RBI is telling me to be extremely strict. Checks and balances are extremely strict as far as bank loan rating is concerned. I will follow the same norm for your NCDs and bonds also. So in that case, there is no anomaly. But if a rater chooses no, I'll follow the little softer approach in relative term. So then there could be anomalies. A same entity can have different ratings for bank loan as well as bonds.
When you talk about this, does this mean that the liability of the rating agency would increase? They can't say that this was just an opinion. Does that mean that?
Absolutely. Rating agencies, I not call it liability, the responsibility will increase manifold. They need to work more like an auditor. Earlier, it was many cases of the question of trust. They have to get it deep into it. So more. I mean, in some cases they may need even forensic audit. And you see, there is a difference when in case of a bond issuer, even a one-day default they can track because the trustees they get to know. But in case of bank loans, they cannot track that. It takes time for them to actually get into this because there is a mechanism within the Reserve Bank of India where the banks exchange information, but this is not available to you and me, and even to rating agencies.
Okay.
So that's the problem.
Let's move on to the other side of the spectrum, the companies. You talk about this non-cooperation part of companies which don't want to get rated or who have to get rated but don't, just to escape scrutiny. Now, what is the solution there? Would they come into the ambit after these October 21 changes or not?
No, this is a very, I'm glad that you pointed out. In the rating universe, a large number of companies, they are non-cooperative, they call it. I mean, you are a company, I rated you, but I would like you to continue with the rating, which you need to, but you are just not giving me information. So how do you belong to that non-cooperative company. Now, why do you do this? And why does a bank also entertain such an entity? There you need to look at it. Up to BBB, the bank's requirement is 100% risk weightage.
Yes.
Now, anything below BBB is bank requirement is 150% risk weightage. Meaning, instead of 9 rupees, I'm a bank, I need to set aside 13.5 rupees.
Yeah.
But an unrated entity, or which those kind of non-cooperative entities whose rating is not available, for them is 100% rating. So it's less.
So
somebody who feel certain that I would get down to BBB minus, and so that the risk weightage will go up and my pricing of loan also will go up. So why? Let's not cooperate. Let's get into the bracket of unrated entities, etc. So my understanding is this. This is one issue. It needs to be sorted out, and both the regulators have been talking on this. But meanwhile, the number of cases have been rising.
Yeah.
And one more, you are not asking me, but I am on my own. I am saying this. Is this unlike the others, like a mutual fund and banks and all, there are even microfinance entities. There are SROs, self-regulated organizations. So there's a close coordination. IBA for banks, MFIN and Sadhan for microfinance entities, MFI for MFIs. But for rating agencies, there is no SRO. I believe there is some attempt to put in place an SRO, but certain entities, certain raters who are owned by overseas entities, they are not part of it. So it's non-functional. So one of the way of sorting all this thing out is greater cooperation among SEBI, RBI, as well as rating agencies through an SRO, which at this point of time happening because there is no SRO.
Thank you. Thanks a lot for your time this week. We hope to talk to you again soon. Thank you.
Thank you.
Tamal says the rating agencies need to have a self-regulatory organization for there to be a standardization. That's all for this week. We'll be back next Thursday at 11 with more news and developments. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.